Hello everyone, welcome to our new CRU Fertilizers webcast. Today we'll be taking you through our point of view on the downstream fertilizer markets, primarily focusing on the outlook for the next 6 months. My name is Chris Lawson and I will be chairing this session today, asking all the tough questions for the analysts and reporters involved. Why are we doing this? We want to provide our clients with a short, sharp and data-driven view on what's happening in the markets. We think it's important that we have some visuals with this. We certainly love charts and all the visuals that go with it, so we think it's important to have that supporting the audio. So today on the phosphates market we have Tom McIver. Tom is our short-term phosphates market editor for Fertilizer Week, calling people around the world each day to form our weekly phosphate price assessments. Following Tom, we'll have Keshni Sridharan, who will be taking us through the urea markets. Keshni is the editor of our Urea Market Outlook, which is a quarterly report analysing longer-term urea market trends and data. Matthew Hodgkinson will be running us through the view on UAN markets. Matt works in our nitrogen team, helping them cover longer-term ammonia, urea, nitrates and explosives markets. And then at the foot of the bill, or however you want to look at it, perhaps even headlining, we have Humphrey Knight, who heads up our research on the potash markets. Again, focusing on the longer-term outlook. Of course, this recording is being done from home from lockdown London, so please ignore any car horns or cat meows you may hear. So without further ado, I'm going to hand over to Tom, who's going to take us through what's happening in phosphates and the view going forward. Over to you, Tom.
Thanks, Chris. After a few key changes in May, we've revised up our DAP map price forecast to recover $10 to $20 per tonne, depending on the import markets by the end of Q3, before easing back down slightly in Q4. And there are a few major factors driving the change. On the supply side, Chinese DAP production eased somewhat in May from rates at 70 to 75% in March and April, as multiple suppliers carried out maintenance and set a target of 65% rates to push for their targeted 310 per tonne FOB sales. While it remains to be seen if suppliers will be disciplined enough to achieve this goal, in the meantime, DAP availability from China for June is very limited. There were indications of high supply from OCP, as Morocco's ANP reported a 63% rise in granular phosphate exports in the first 4 months of the year. However, OCP is set to cut its Jorflosphar granulation in June to 600 to 650,000 tonnes from previous plans of roughly 800,000 tonnes, with a possible similar curtailment in July. Multiple other DAP map suppliers, including Eurochem, Fosagro, GCT and Mosaic, are largely sold out for June shipment and are holding higher offers for July cargoes. India has been slow to return to normal phosphate fertilizer production rates after the country's COVID-19 lockdown at the end of March, with DAP production in India from January to May down roughly 450,000 tonnes year on year. On the demand side, despite the slowdown in domestic production, Indian DAP imports are down in Q2 year on year by as much as 500,000 tonnes. Rainfall expectations for India's southwest monsoon, which made landfall this week, have been revised up, and Indian DAP consumption has been already very strong in April and May. CRU expects India DAP stocks to enter July down at least 1.5 million tonnes, and Q3 DAP imports are set to rise roughly 1 million tonnes year on year. The outlook for H2 DAP map pricing in North America is also more bullish than entering May, amid reduced supply and low stocks after good spring demand. Very strong barter ratios and crop margins in Brazil should also support prices somewhat, but overall Brazilian MAP imports in the second half are likely to be limited due to excess purchasing during H1 and high stocks. The slight recovery in DAP map prices in the Americas seen in the last couple of weeks is expected to continue gradually through September, supporting a slight rise in the Indian DAP prices too from July. However, the key risk to this forecast is to the downside, that suppliers are not disciplined regarding output, particularly from China, and this drives down expected prices through the second half of 2020.
Thanks, Tom. Interesting to see a bit of a change in view on the phosphates market there. It's fair to say there hasn't been much upside in that market for the past couple of years. You mentioned there China and that the kind of the risk to the forecast being more on the downside. Just how influential do you think China could be to the forecast, and what would happen if they did start to operate above their kind of stated rates which they're aiming to operate at?
Yeah, I would note that prices are still set to remain at a pretty low price environment across the board here, even with this slight increase. And the forecast, as you say, it hinges very, very heavily on what the Chinese choose to do. This forecast essentially assumes roughly 68 to 70% rates from China, so above the 65% rates that they are targeting, but below the levels of last year. If the Chinese suppliers do keep to the 65% target, then prices could even see a slightly larger recovery than we have here. But if rates are seen at 75% and above, then oversupply returns and prices, particularly east of Suez, would fall even further in the second half of the year. So really heavily is dependent on what happens from China from now.
Okay, China as critical as ever. Thank you very much for that overview, Tom. We're going to move on now to Keshni. Keshni, what's happening in urea markets?
So global urea prices, particularly across the granular benchmarks, fell quite sharply in May on the back of lower seasonal demand in the US, Brazil, and Europe. The increased volatility observed particularly at NOLA was also partly a result of the weaker price sentiment driven by the uncertainty around COVID-19 and the wider macroeconomic concerns around a recession. As a result, we've lowered our price forecast for granular urea in June and July, but still maintain our expectations for a recovery in prices from September. Higher import demand from India, along with seasonal purchases in Europe and Brazil ahead of the 2021 planting season, will provide that support for prices. Our view is that India will need to tender for 4.5 million tons in the second half of 2020, taking their total imports for the year to 8.7 million tons, which is only slightly lower than the previous year. Now, this is not expected to support prices in the interim, as ample supply is reported to be available from the FSU and the Middle East, and we also expect Chinese exports to resume from mid-July, which is the end of their domestic demand season. Full-year Chinese exports are forecast at 4.2 million tons in 2020. The key risk to our price forecast is skewed to the upside, and this is founded in the timing of Indian import tenders and Chinese export availability. We could see imports via the Indian tenders increasing above forecast levels if the OMIFCO contract volumes aren't renewed in July, and if this is combined with a cutback in Chinese exports, this will help support prices and result in prices rebounding earlier than forecast. Now, Chinese coal prices rallied at the end of May, and if costs in China remain high, this is likely to lift up domestic prices, and we could see Chinese exporters pulling back from the market and lowering utilization rates at least until September, when you have more domestic demand in China, and this could result in overall urea prices recovering from July as opposed to the September we have there.
Okay, thanks, Keshni. So some fairly steep declines in those nitrogen markets lately, which we can see on those charts there. I mean, in terms of that rebound that you talk about there, you can see in the latter half of the forecast. What do you think would need to happen to make that rebound occur sooner?
So similar to phosphates, I think the biggest factor here and the biggest risk is what happens in China. Now, as I said, this is something that we've looked at as part of the urea market outlook. Our base case forecast is for Chinese coal prices to not move substantially higher from the current levels, as demand continues to remain firm for that coal, but supply is also abundant. However, if you continue to see an increase in coal demand in China as a result of higher industrial production, and if coal supply continues to be impacted, then we could see coal prices rising above current forecasts. And this could result in a scenario where the bituminous coal prices rise from about 540 RMB at the end of May, going up to about 605. And what this means in terms of urea prices and costs is that Chinese producers will be unwilling to sell below that $217 per ton cost cap. And that's likely to result in Chinese exports falling below 4 million tons. And this will be enough to reverse that global price sentiment that we're seeing. And this will be more supportive of global prices, particularly under the next Indian import tender, which is expected in June for delivery in mid-July.
Okay, thank you. So just to be clear on that, so for those that are listening, so if we see coal prices rebound more than expected in China, that therefore lifts their cost of production floor, makes them less willing to export to the market, and will tighten that export availability. Is my very basic summary of that correct, Keshni?
Yeah, that's right.
Okay, fantastic. Right, staying on the nitrogen markets, Matthew, do you want to run us through what's happening in UAN and the view there going forward?
Thank you, Chris. I'm going to start off by taking you through our view for Europe, which is shown on the light blue line on the chart on the left-hand side there. So prices at Rouen peaked at 156 euros per tonne towards the end of April, but have since dropped off due to hot and dry weather, which has discouraged UAN application and lowered offtake in May. We're expecting prices to decline further from May, and this is on the back of these demand fundamentals. Our price forecast that we previously published had June prices at 149 euros per tonne. However, we're now expecting prices in June to average 143 euros per tonne. Beyond the end of June, we're expecting prices in Europe to decline at slight increments down towards 138 euros per tonne by the end of the forecast period. Moving on to the US, where spring demand was a lot stronger compared to Europe. This resulted in NOLA prices peaking at $155 per tonne towards the middle of April. However, since then, prices have declined steadily, and this is a direct impact of the colder weather, which has impacted UAN application as sidedress in some parts of the Midwest. It's for this reason that we have also revised our June monthly price downwards. So our previous forecast had this pegged at $140 per short tonne. However, we're now expecting this to be $135 per short tonne. Beyond the end of June, prices are expected to decline steeply in line with seasonal demand fundamentals, where they'll reach $120 per short tonne in July and August, before peaking up a little bit towards the end of the forecast period in line with fall application. The main risk to our forecast is to the downside. So if I can turn your attention to the chart on the right-hand side, this shows monthly US UAN imports from Russia as reported by the United States. And you can see that Q1 2020 deliveries have been considerably lower than in Q1 2019. Part of this has been down to an increase in volumes from Trinidad, but these volumes have not quite offset the deficit. The main reason behind this is that Russian nitrogen demand domestically has been stronger than previously anticipated and stronger than 2019. However, these volumes are now expected to increase in terms of Russian exports to the US due to the fact that the Russian domestic demand season has finished. This increase in volume could conceivably lower prices beyond what we're expecting for the remainder of the year.
Okay, thank you, Matthew. So looking a little more gloomy, I guess, from a UAN price perspective, Matt, I'm interested to know, one of the things we look at quite closely here is the incentive for producing urea or UAN for those producers that have that flexible capacity. Where are we at in terms of that incentive at the moment? What should producers be looking to produce, and how might that change over the coming months, considering the two forecasts that have just been presented?
So in the past 12 months, producers in the US have been heavily incentivized to produce urea over UAN, and that's simply a fact of the UAN market there being slightly more oversupplied than urea. Going forward, based on our price expectations for NOLA for urea and UAN, that trend is set to continue. So that incentive will remain in place to produce urea over UAN at least until the end of 2020.
Okay, good, thank you. And last of all, we have our view on potash markets. Humphrey, over to you.
Thanks very much, Chris. And yes, certainly much quieter the last couple of weeks in potash markets compared to the comparative drama of the new contracts being settled relatively recently, but still plenty to talk about. So in short, we have revised up our price forecast over the next 6 months. And this comes off the back of the agreement of those new contracts, which has set a new price floor for the market and actually induced a rebound in some spot prices around the world following more than a year of declines across most. So just starting with those contract markets. So from our previous short-term forecast, this occurred just after the settlement of the new Chinese supply contracts. This was the first time in more than a year and a half that Chinese importers had agreed a new contract. And a couple of weeks ago, their Indian counterparts did the same. So they agreed a new contract at $230 a ton CFR. That means that now has a $10 premium over the Chinese contract, but nevertheless is a $50 per ton decline on the previous contract in India agreed at the end of last year. It's worth just mentioning now that essentially we are expecting these contract prices to remain set at their current levels for the remainder of the year. Just very quickly focusing a bit more on that new Indian contract price, and I just draw your attention to the graph on the right. What the new contract does is it allows Indian importers to lower the domestic retail price of MOP in the country for the first time in well over a year and bring it down from record high levels. Now, the maximum retail price is strongly linked to Indian demand. When it's very high, demand is generally significantly lower. With the MRP coming down now, what this means, although that is a negative for producers because there's a lower contract price, it is a positive for consumers. And as a result, we do expect consumption to increase in India in 2020, and that's what the graph is trying to show you. Moving over to the spot markets and starting with Brazil. So demand for MOP in Brazil remains very strong, and this has helped to lift Brazilian prices in the last couple of weeks off that decade-low floor of $215 a ton CFR, and it's now at about $10 above this at the time of speaking. For looking at imports for the first 4 months of the year, we could see that although these were a bit lower on 2019, they were still the third highest in the last decade. So demand remains very strong, and we are expecting it to remain that way for much of the rest of the year. What that means for prices is we are expecting CFR Brazil to reach $245 a ton average by the end of the forecast period. And then finally on to Southeast Asia, and a very different story in this part of the world. MOP demand across the region remains reasonably weak, and this is largely due to slow demand and low prices in the palm oil sector, which has been significantly impacted by the coronavirus pandemic. Ultimately, we are expecting this situation to remain largely the same for the rest of the year and demand for MOP to remain somewhat limited. Nevertheless, the new contracts do set a price floor in the region. At the moment, MOP prices in Southeast Asia are at an average of $240 a ton CFR, and for all intents and purposes, we are expecting this to remain much the case for the rest of the year. Finally, our key risk is to the upside, and this refers to Brazil. If MOP demand is even stronger than we are forecasting here, we would expect prices to be above our base case forecast.
Brilliant, thank you, Humphrey. So a bit of a turning point, it seems, in the potash market there after its time in the sun last month. Interested to know, with the new contracts that have been signed in both China and India, is that finally going to help to tighten supply and potentially raise prices outside of Brazil?
Potentially, yes. This is what the contracts should do. The big sort of missing piece of the MOP market over the last 6 to 12 months or so has been that Chinese contract in the second half of last year, and we've seen spot prices fall really consistently. So with that now in place, that should ultimately tighten the market. The question is kind of when that will occur. The one thing that's really important is that particularly in China, stocks in China are exceptionally high and probably the highest they've ever been at the signing of a new contract. And they will need to be cleared before China really requires substantial new import supply. So it could be a number of months before we see that supply tighten and that translate through into any price increases in spot markets kind of outside Brazil. So it does look like it will happen, but it just could take a lot longer than it would otherwise.
Okay, so monitoring that Chinese stock number is going to be key to really determining when that more kind of significant price turnaround may happen.
Absolutely agree with that, yeah.
Okay, fantastic. Well, thank you very much for that, guys. Appreciate the input, and hopefully everyone listening does as well. These are all found in our short-term price forecast, which we are publishing on the first Tuesday of every month. For our Fertilizer Week subscribers, you can click through on the link there to find them. And you can look at them on the CRU Online platform or download them as a PDF. Market Outlook subscribers also get access to these through the analysis part of CRU Online. Don't forget, we will be doing another one of these focused on the fertilizer raw materials market. So this will be kind of posted adjacent to that. Needless to remind everyone, we've recorded this on Tuesday, the 2nd of June, just in case there are any major changes in the markets from now to when you listen to it. And we here at CRU in the fertilizer team, we love questions and we love feedback. So if you have any questions on what has been presented today or anything else on the fertilizer market, please do not hesitate to get in touch with any of us. And of course, if you have any feedback on how useful you found this or where we can find some potential improvements, please do let us know. But thanks everyone for taking part, and thank you everyone for tuning in and listening.